Welcome back, and you're watching Markets at Noon on ET Now. Let's bring on board the management of Vaibhav Global. We're joined by Vineet Ganeriwala, President at Vaibhav Global, to talk about the markets, the scenario, the demand trends. How is that actually shaping up for the company now? Thank you so much, sir, for joining in with us this afternoon on Markets at Noon. And, I want to just start by talking about, given the current scenario, what is going on in the US, obviously that's in the banking financial space. But the sentiments overall, there were a lot of global macro challenges already going on. Sentiment was a bit weakish as well. Do you expect more impact of this coming in, especially in terms of your business in the US?
In terms of the current scenario, we do see muted demand in US, UK, and Germany markets, more led to the inflationary kind of a scenario, which we are seeing since last more than 12 months now. But we are a value player, so we offer high quality value products to the customer at compelling prices. So we are taking proactive measures to take advantage of this situation rather than get impacted by it. So we have been expanding our under 10 and under $20 portfolio quite aggressively in the last many months. And we keep on investing in expanding our TV footprint, our digital and OTT footprint. So while our demand is muted a little bit, but we are rapidly gaining market share in such scenario. And to that extent, we are pretty pleased by our performance.
Okay, so I want to talk a bit more about your performance because muted performance even has continued now. The last couple of quarters was also a bit muted as well. Could you give us more specifics in terms of your UK market? Are you seeing a deterioration further there, or are you seeing any early signs of revival finally coming in the UK market?
So we still see muted demand. So the inflationary pressures is still there, though quite silver bit of silver lining in terms of that the rate of inflation have started reducing in all the geographies we operate, US, UK, and Germany. But still it has a level where we would like to see it come down much more from wherever it is today. So to that extent, the macroeconomic environment is still a little bit of challenging. But like I mentioned, we are a value player. So and also our vertically integrated supply chain gives us a lot of strength in terms of agility to quickly respond to rapidly changing consumer demands. So in such scenarios, the demands of the consumer are changing more and more rapidly, and we are in position to take advantage of that. Our growth, if you see in the last quarter, in spite of all this inflationary economic environment, we were minus 3.6% year on year in Q3 last quarter. However, it was also impacted by two major unforeseen scenarios. One was we got hit by a cyber attack, ransomware attack. And secondly, all the major delivery partners in UK were on strike in that quarter. And that it was an industry-wide impact out there. Had this not been there, we would have been flattish year on year in Q3 in spite of all this challenging scenario. So while the demand remains muted, still, but we are taking all the right steps to take advantage of the situation and keep expanding our market share in all the geographies we operate.
Given how the month of Jan and Feb have been panned out so far, do you believe that you will be able to achieve your Q4 guidance of a flat to 2% top line growth?
We have given a guidance of flat to 2% positive for Q4. We are in line in terms of trends. We are absolutely in line with that. So our full year will be somewhere between -3 to -2 as per this guidance. And for the next coming year, FY24, we have given a guidance in spite of all the macroeconomic headwinds. We have given a guidance of 8 to 10% positive year on year. And FY25 will be a normal mid-teen kind of a guidance coming. We'll see that coming back again from FY25 onwards.
So EBITDA margin improved in Q3 on a sequential basis. You have also categorically stated that EBITDA margins bottomed out in Q4 FY24. How much of margin expansions are you aiming for?
So we have been aggressively investing since last many quarters now. So in spite of the muted demand, we were investing in expanding our digital. We accelerated our digital investments. We expanded our TV footprint. We went into Germany 2 years back and have been investing there since. So all this had a little bit of pressure on our margins. But Q4 of last year, our margins had bottomed out. And from there, from 6.9% EBITDA margins in Q4 of last year, we have been increasing margins again quarter by quarter, and Q3, the last immediate last quarter, we were at 10.5% EBITDA margins. So we believe that it has already bottomed out in the last year, and all the investments which have been doing will only give benefits in the long run. So we don't give any margin guidance as such. What we always say is that with positive revenue growth, our business model is such that we'll continue to see operating leverage. And for the next year as well, so at an 8 to 10% kind of a revenue growth year on year, we'll see operating leverage in next year.
Okay, and given the recent surge in gold prices, has the demand for gold jewelry, gold-studded jewelry, seen an increase? You know, people do move on to that safe haven commodity. How is that shaping up?
So, not earlier, like unlike earlier times, we are seeing a very high demand for gold in US and even in UK and Germany. So maybe people are looking at as a safe haven uh, against all these rapidly changing macro environments. So both for pure gold, like plain gold jewelry, as well as gold gemstone based gold jewelry, we are seeing quite a good demand out there. And again, like we mentioned, we are a vertically integrated supply chain, so we are able to pivot very quickly and increase our supplies and cater to that rising demand.
Right. And, just want to understand, are you looking at any new geographies? Obviously, Germany was one of the recent ones which you entered in the last couple of years. So any new geographies that you are watching out for now?
So we are not looking at any new geography expansion in the immediate, like near midterm. We would like to stabilize Germany, make it positive, and let it start contributing to the bottom line of the group. Having said that, in all the three geographies, US, UK, and Germany, where we operate, we are rapidly expanding and accelerating our growth pillars. So, be it TV footprint, be it digital investments, or be it OTT footprint. So, all the platforms which are levers of our future growth, we are expanding and accelerating in all the three geographies. So, that way, it's an expansion of like within the geographies, but not a geographical expansion on the cards shortly. Once Germany starts contributing meaningfully to the bottom line as well as top line of the group, we may evaluate our position again at that point of time.
Thank you so much, sir, for taking out time for us. Good to get perspective. It's really been a long time before when we had spoken to you. Let's now